This house in Seattle, Washington is listed at $625,000, and we're going to be talking about what it would look like to buy this house if you have $100,000 saved up for a down payment. So we're going to look at a real quote, and on that quote we'll see what your monthly payment might be. We'll see the final number, cash all in, where the money goes in terms of if you have $100,000, how much of that is going to be closing costs, because there are going to be closing costs involved. And then we'll talk about how much income it would take to qualify for that monthly payment. So with that, we're actually going to look at two different quotes so that you can see two different possible scenarios of how much income you would be making. There's different ways we can set up the loan and use that $100,000 depending on how much income you're making in order to qualify for that. Hopefully that will give you a better idea than just looking at an online calculator. It'll give you a little bit more detailed and reliable information, and it'll give you a little bit behind the reasoning behind why the numbers are what they are, how they might differ if they do. My name is Landon Buteau, and I work with a local mortgage broker, Cleveland Street Mortgage, based in Bothell, Washington. So this is a real quote. They're not exact numbers that you're going to be seeing, but they are a good estimate of what you're going to be looking at. So let's go ahead and look at that quote. All right, so here is the quote that we're going to look at, and you can see there's two different quotes here, one on the right, one on the left. And you can see there's one where the monthly payment is $4,280 and one where the monthly payment is $3,947. And then you look down here and you can see the cash to close, the cash you're going to have to bring to the deal in order to get that is basically the same, $101,000, almost $101,000 here. So the cash is basically the same. So how does that happen? I'm going to walk through that. Before we get into that, there's something I want to explain that I'm assuming behind this quote. So one thing, because the quotes that you get when you come to get a mortgage, your options aren't just all the same for every single person, just depending on your down payment. It's dependent on a lot of different things. You're probably aware of that, but two of the key ones are obviously your credit score. So credit score of 740 is what I'm assuming for this. That's a pretty just average number. You could be, if you're reasonably close to that credit score, your pricing's not going to be drastically different. It just gets incrementally better if you get a little bit higher, and incrementally worse if you get a little bit lower. If you get down into the 600s and definitely below 620, then it's going to be pretty significantly different. But if you're in this ballpark, if you're in around the 700s, it's going to be pretty similar. The other assumption that I'm making for these quotes has to do with your income. Now, obviously, in order to qualify for the loan, you have to be making a certain amount of income. You're aware of that, I'm sure. But there's another important factor that affects the interest rate and the pricing that you get, which is there are certain loan programs that are only available to people who make less than a certain amount of income. Those are called affordable loan products. And for one of these, for this one right here, I'm assuming you are making, this is using one of those affordable loan products. I'm assuming you are below that threshold in income, which is usually, for this scenario, sometimes certain products are 80% of area median income. You have to be below that. Some products are 100% of area median income, and then some are 120%. It just depends on the loan product. But here I'm using the one that assumes you're below 100% of area median income for this King County area. This one I am not assuming that. Last thing, for both of these, I'm assuming you are a first-time home buyer, which, again, if you are a first-time home buyer, sometimes that can improve your pricing. It gets you into certain programs that you might not be able to get into if you are not a first-time home buyer. So let's look at the actual numbers and see how they're different. In this scenario here, what we did is we just put all of that cash towards the down payment. Now, of course, you have to have closing costs covered, so we have to budget for that. So we just put everything besides the closing costs towards the down payment. So we ended up with a down payment of 14% on this $625,000 house because we had to budget for closing costs, and we're capping this as slightly over $100,000. So we're assuming that's what you have. In this scenario, what we did is we put a decent amount towards points. We put $25,000 towards points. Now, points are a fee that you can pay up front in order to get a lower interest rate. And the reason we did that here is we only have $100,000, but we're putting less towards a down payment and putting more towards points to get a lower interest rate. Because even though we've had a lower down payment and therefore a larger loan amount, 562 here, 537 here, even though it was a larger loan amount, being able to lower the interest rate to 5.625 versus 6.999 made a bigger impact in terms of our monthly payment. Which means that you might be able to take that on, you might be able to qualify for that loan, even if you don't make quite as much income. So if you're in that, I haven't done the calculations yet. We'll do them at the end to see how much income you would be making to qualify for each of these scenarios. But if you're not sure whether you're making enough income to qualify for these, if you're on that lower end, and we'll talk about what the exact numbers are, I'm guessing it's going to be, you're going to have to be making definitely probably $90,000, $100,000 a year to qualify for this one, and more to qualify for this one. So if you're not making more than $100,000 a year, you might have to pay points. So that's why I'm illustrating this situation. So let's look at the actual numbers involved. Let's start with the scenario. Actually, let's start with the qualifying. I'm actually going to show you that first, which I don't do normally, because then it'll make more sense why I'm doing this the way we are. So the way qualifying works, the way lenders figure out whether you can qualify for a loan, is they take your debt to income ratio, your DTI. And your DTI, your debt to income ratio, is your total monthly debts over your gross monthly income. Your income before taxes, gross monthly income. And this number for conventional loans needs to be less than 50% in order to qualify for the loan. So it's slightly different for FHA. The calculation is the same for FHA, but the number used is slightly different. And then for VA, it's pretty significantly different how it's calculated, so that's a different question. But for conventional, this is how it's figured out, whether you can qualify for the loan, whether the lender will give you the loan. So they take your total monthly debts, which is your new housing payment that you're trying to take on, plus any other monthly debts that you have, credit card, student loan, car debt, any other debts. They add that all together, and that's your total monthly debts. And then they divide that by your gross monthly income. And if that number is less than 50%, then you're good to go. They'll let you take on the loan for the most part. That's a pretty good general rule for how it works. One note on that is in determining what your gross monthly income is, if you are salary, it's very straightforward for the most part. It's typically very straightforward, and they just use whatever your salary is. But if you have other forms of payment of income, if you are self-employed, if you are variable hours, if you work largely on commission, then there are pretty rigid rules in terms of how they figure out what number they will use for this, what income they can count on for you. So just be aware of that. If you want to learn more about that, feel free to reach out to us. Put a comment below if you just want to ask questions on that, or find our contact info in the description below. But so that's the equation they use. So if that's the equation they use, you have to be below 50%. Let's figure out what income you would have to be making for each of these scenarios in order to qualify. Now for this calculation, I'm going to assume that you have no other debts. I'm going to assume you don't have any other debts going on to add to this top number. I'm just going to take this monthly payment and see what income you would need in order to qualify for that if that's your only debt. If you have other debts, you would just have to add that to this top number here and then divide it. All right, let's look at these. Let's do the calculations then and see what income you would need to qualify for these two scenarios. Let's start with this one on the left. That's going to be, what is that? $7,894. Let's see if I got that right. I did, sweet. So that was right. That was a weird way of doing it. I've not really done it like that before, but it worked, okay? So $7,894 per month is what you're going to have to be making to qualify for this loan here. And what is that for per year? That's $94,728 per year. in order to qualify for this loan. So the one on the right then is $8,540 per month. Let's check it. 8,560. I don't know where I got 40. Okay, 8,560 per month, which per year is 102,720. Okay, I'm not trying to deceive you. I did use the calculator for that. 102,720 per year. So in order to qualify for this one, you have to be making a little bit more. It's not that drastically different, but it could be just the case that. So one situation that could come up is maybe you and your spouse are trying to get a house, and you guys together, you make $125,000 a year together, or you make $150,000 a year, whatever. But let's say a lot of that is variable, or a lot of that is commission, and for whatever reason, the lender only credits you. The lender only says you're making $95,000 per year together. That's what they're giving you to work with. That's the income they're using in order to qualify you for a loan. So let's say you are right on that edge. $95,000 a year is what you could qualify for. Maybe you make more than that, but this is what you could qualify for. And this house comes up that is just perfect, but the monthly payment is going to be, if you just put all the cash towards the down payment, the monthly payment is going to be $4,280. You can't qualify for that. So maybe the loan officer gets creative and says, okay, you can't qualify for that, but you could afford it. You could afford this monthly payment. Even though the lender won't give it to you, you're comfortable taking that monthly payment on, and you just love the house. Okay, so instead, we're going to do whatever we can to get this monthly payment down so that you could qualify for it. And the only way we can do that is by putting a lot of your money, $25,000, towards points to buy the rate down in order to get a lower monthly payment. So that's why that might come in handy there. So that's the two payments. I'll walk through the components of what they're made of. So this one on the left is $3,947, and 150 of that. There's four components here. The first is homeowners insurance, 150. And that's an estimate. This house is listed at $625. That's a pretty good estimate probably for what you're going to be looking at. That's a pretty common number that we see for this price point. But that number could vary. It depends on your insurance provider and how much you're getting covered. So we're using 150 for an estimate. Taxes, this number is actually drawn from the county website for this specific house for 2024. So this is the actual number you're going to be seeing, $461 per month. Mortgage insurance of $98 per month. Mortgage insurance is something you have to pay if you put less than 20% down. 98 is a pretty good number. That if you have a lower down payment or lower credit score, this could be higher. It could be in the 200s. But this is a pretty good number to end up with. And then the last section is principal and interest, which is based on your loan amount and your interest rate. So over here in the 14% down scenario, we have a monthly payment of $4,280. Homeowners insurance is the same. Taxes are the same because those are based on the house, not your loan structure. $94 a month. If you're able to get to 15% down, that could knock this down significantly, but we don't have that cash for that, obviously. But if some way you were able to scrounge together the cash, if you were able to get to 15% down, that puts you in the next threshold as far as they're determining your risk with mortgage insurance. So that could bring this down significantly, maybe to $40 or $50 a month. The exact number I don't know, but it will knock it down significantly. Obviously, it only went down $4 per month. And then the last section is principal and interest. Here, technically, we're showing a credit of $586, which means the lender says if you take a slightly higher interest rate, I'll give you some cash to cover your closing costs. That's what a credit is. But you can see here, obviously, it takes a lot of cash to make any difference on the interest rate. This is basically, these just don't show at $0 credit, at $0 points. That's not the way lenders show their rates. So this is as close to zero as it gets, really. And then closing costs in both scenarios of about $12,500, a little over. And closing costs are made up of any costs it takes to get the loan and to get the house, any fees and services you have to pay in that process, and then also the other component is prepaids. And prepaids are just costs you're going to be paying on an ongoing basis with your mortgage. But when you initially get it, you have to put some of those into escrow ahead of time while the lender gets you set up to take care of some of your costs for the first period of having that mortgage before you actually start paying the monthly payment. And then both scenarios cash all in of about $100,000. I hope that's helpful to think about how points can be used to make an impact, what you might be able to qualify for right now if you have $100,000 in cash, how much income it would take. Hope that gives you a sense of what we're looking at in the Seattle area. If you want to get a look at your own quote on a house that you're looking at, we'd love to do that for you. We are a local mortgage broker in Bothell, Washington. We do loans in Washington and Idaho. We tend to be really competitively priced, and my dad has been doing this for almost 30 years, and I work closely with him, with our team. So you can reach out to us at any of the contact information in the description below. We'd love to work with you.